Beautiful. Thank you guys so much for being here. We're just waiting on Dr. Murphy and I believe James, and we will kick things off here. Thank you to those in the audience that are listening in. We've got a really, really exciting space for you guys planned today. You guys are tuning in to our whole life insurance and infinite banking space series. And so we have the number one influencer on X today with us, Nate Dean. And so we're very excited to have him. We have Dr. Murphy here as well. So I'm going to invite him to speak. Perfect. Dr. Murphy, can you hear me all right?
Yep.
Perfect. Okay. I believe we're waiting on one more, but we do have some people in the audience here, and we do have a pretty full stage, so I can probably get going with our introduction here. So what I'm going to do real quick is I'm going to pin a tweet so that if you guys are interested, you can ask any questions, and we'll make sure and pass that through to the panelists. But you guys are joining us for a very, very special space, as I started to say. Whole life insurance is not rocket surgery with Nate. And so what we're going to do today is run through a little bit of the simplicity of whole life insurance. Nate has recently come out with a YouTube video that I'm also going to put in a pinned tweet here shortly. And in that pinned tweet, you'll see the video that Nate recently produced, which really breaks this down and will kind of be outlined for our conversation here today. And so with that, I'd love to let Nate introduce himself from Unlimited Life Concepts. And so, Nate, if you could give a little introduction to the audience here and a little bit of background on yourself, that'd be great.
Okay, can y'all hear me okay?
I can hear you perfectly.
Perfect. Well, first off, thank you so much for the invitation to come and just kind of share my story and my insight. Really is an honor, especially with my background in the infinite banking space. To be closely connected to Dr. Bob Murphy is an honor because Bob was a mentor, indirectly and directly a mentor of mine early on in my journey. But let me tell you this, if you get to know me, you find out real quick that I don't shy away from my faith or anything like that. And in the Bible, God has a history of using unlikely people. And I say that to say I'm sitting here right now, very unlikely to be on this side of the personal finance space. And here's why. Me and my business partner both were hardcore Dave Ramsey fans, hardcore Dave Ramsey followers, like fighting people, like arguing with people over, Dave Ramsey stuff. Anyways, so to be where I'm at today is pretty crazy. And so for anybody who hears that and you are a Dave Ramsey follower, let me just tell you, there is hope for you in this world. So I got started in the infinite banking space as a coach, as an authorized practitioner. I was fortunate to be mentored by a couple of great guys from a company called Life Success and Legacy, Mike Everett and Chris Bay, and got started in that space first as a client and just figuring out how to implement the infinite banking strategy in my own life. I was introduced to, or I came across Nelson Nash's book, Becoming Your Own Banker, in 2017, shared it with my friend who is now my business partner, and it just revolutionized our lives. We just celebrated our 6-year anniversary of Unlimited Life Concepts, our company, and just, grateful to be here. I'm in Texas. I've got 4 kids. I'll be married 22 years this year. I don't look my age. It's a lot of fun. I don't know what else you'd like to know about me, but I am here to answer any questions.
Nate, I think that was perfect. Thank you so much for that background and for that inspiration. For any of those listening that aren't familiar with infinite banking, aren't familiar with whole life insurance, you can learn. And more importantly, you can unlearn, as I know Wayne Durksen likes to say. And with that, we do have a bunch of panelists here from the Infineo team that are going to be helping add color to this conversation. And so with that, I'd love to let the Infineo team introduce themselves. Potentially, Dr. Murphy, if you'd like to start, that'd be great.
Yeah, sure thing. So you're right, Nate. You told me you got married 22 years ago. I would have thought when you were -3. So yeah, that's I'm exaggerating obviously a bit, but that's great. We're glad you could join us. Folks, I've known Nate for a while now, and I've been following his career with great interest. He's really good at, besides explaining whole life insurance. He's very big on Twitter and other social media avenues, I believe, and so that's partly what we're going to cover in this episode. So I'm the chief economist for Infineo. I have a background in the Austrian School of Economics, and I have done a lot of work on the mechanics of whole life insurance and the economics of it and how does this work. So I'll keep my remarks brief and let the others speak.
Beautiful. George, would you like to go next?
Sure. Thanks a lot. Welcome, Nate. Thanks for joining us. Thank you, Dr. Bob. So I'll just say quickly, I'm the director of Infineo Canada, and I've been practicing and teaching infinite banking since 2010. So I was one of the first to join the Nelson Nash Institute. It wasn't called that at the time, and take the practitioner course. And I've been authorized with the Nelson Nash Institute ever since. Very proud to be a part of that organization and share Nelson's message as often as I can.
Thank you for that, George. And we still have two panelists. Wayne, would you like to go next?
Thanks, Jackson. And it is fun to be on a panel with some great other panelists and to also learn each time. But I've been around a long, long time, and I'm an old dog. It takes me a long time to figure things out, but truth always wins. That kind of lines up with what Nate was referring to in his faith side. And Nelson Nash was kind enough and gracious enough to be patient with me while I figured out what this actually was. And I am now a raving fan of infinite banking, cash management with whole life. I think the world deserves to know how this works and why it's important, and that capital is your friend and you want to preserve it, protect it, and leverage it forever. And so that's kind of my story. That's where I'm at, and I've given my life to this. So very excited to be part of this team.
Thank you very much, Wayne. And last but not least, Liz.
Thanks, Durksen. So yeah, I work with, much like George and Wayne, I work with clients, teaching them how to use properly structured whole life insurance. It's a privilege to do so. And it's certainly a privilege to be on this panel with this group of highly trained individuals. And so something that I think gets lost a little bit in the conversation, and if people are unfamiliar with this space may not be aware, is that all the folks here have actually done a deeper dive into understanding these products than the sort of standard training. And so they really understand exactly how to design it and create it to use it in the most effective manner, and also implement it in their own lives. So it's a privilege to be among people who understand it to this level, and I'm really looking forward to the conversation.
That was beautifully put, Liz. Me too. I was literally thinking how stacked of a panel we have here today and how excited I am to dive into this conversation. And so with that, I think that we're through all the intros and we can start getting into the meat of it. So as I mentioned earlier, Nate recently put out a video breaking down the simplicity of whole life insurance. And as he likes to say, how it's not rocket surgery. And we agree. And so I'd like to kick this conversation off today with helping our audience understand the economic value of infinite banking. In your video, Nate, you discussed four main components of the economic value, and those being certainty, control, efficiency, and liquidity. And I would love if I could just open up that a conversation to the panelists discussing those four main components and how they come into play with infinite banking and what they really mean. And I'd be happy to repeat those if needed. Nate, would you like to kick it off?
Yeah, sure. So, as I stated in that video, the four main components of economic value that we focus on and promote through our strategies: certainty, control, efficiency, and liquidity. And the beauty of certainty, when you're able to introduce that concept into your decision-making process, it makes those decisions a whole lot easier. When you're following a process and a model that has a predictable outcome, it really gives you permission to make better decisions about what's going on in your situation. The control aspect of it, I'll just kind of do a rundown and then we can kind of open it up and talk about it. But the control aspect of that, simply the fact that somebody doesn't have their thumb on top of the things that you're trying to accomplish in your financial life. And then we've got efficiency. Efficiency is just making your money do more. I recently used the analogy of basically we're sending our money to the gym to get some muscles so that we can do more with what we've got. And then liquidity is simply just having access to capital. Another mentor of mine, James Nethery, who's big in the infinite banking world, he says the most frustration you'll face in your life is when you have an opportunity that you don't have the money for, or an emergency that you don't have the money for. So when we are positioning ourselves in this manner, we are preparing ourselves for opportunities and emergencies simultaneously.
That's incredible. Thank you for adding that. When you guys hear the Infineo team, those 4 main components from Nate's video, I'm curious what do you guys think about them? Certainty, control, efficiency, and liquidity, and what those mean to you. We've talked about those 4 concepts a bunch more informally on our other spaces, but to have them really formalized into 4 pillars of the economic value of infinite banking is really interesting to me. So I'm curious to hear your guys' thoughts.
Sure, I'll jump in first. I think it's good to this format of having them laid out very quickly and then going through and going and then elaborating as Nate does in this video, because the issue is that we've used different terminology. That in my writings I've called it like the Swiss Army knife, or I said it's for an older crowd I said the Jim Kirk of financial products, because alluding to Star Trek, where the old Star Trek, where Captain Kirk was not, he wasn't the strongest, he wasn't the smartest, he wasn't the best at engineering. All the other people were better in their field, but he was pretty good at everything. And that's kind of like the way I look at a dividend paying whole life product. Yeah, it doesn't have the highest return. It doesn't, any one particular criterion. It's not the best out of all the other possibilities, but it's pretty good on everything. And so in terms of a robust tool that you want to have in your arsenal, or like a headquarters for your money, a warehouse for your wealth, as Nelson also said, it really hits that. And so I like Nate's video, how it lays it all up front and then goes through and explains what he means on each one. So that's just my quick take as we go into this.
Thanks, Dr. Murphy. Liz, did you have something to add?
Yeah, I was just going to say that I think it's, just asking questions, and I think, looking at those 4 that Nate outlined, and looking at other things that people are doing with their money. Do they have those characteristics? Do they have all 4? Do they only have one of them? And what's the result of that? And I think if you kind of play that exercise through, it kind of gives you an idea of thinking about things and why that might be important, and why you might want to consider that for at least one of the assets that you hold, just because of the opportunities that it gives you, and the way that you can then manage the other things that you're doing with your money.
Thanks, Liz. And with that, I'm just looking at the 4 main components here, and it does seem to me, correct me if I'm wrong, panelists, you guys are the experts, that the certainty, the control aspects, and the liquidity are sort of ever-changing. And so I would love to talk a little bit about, in my opinion, if the efficiency does change depending on your individual situation. If you're someone out of college, if you're someone that's just getting their first job, if you're someone that's been in their career for 15 years, if you're retired, does the efficiency of utilizing infinite banking change, or is it pretty consistent depending on your individual circumstances?
I'll say this real quick. So in my opinion, cash value inside of a life insurance policy, again, this is my opinion, I believe those are the strongest dollars that you can ever possess. And here's why. They're dollars that you can leverage in an environment that you control. And there's nothing else on the planet you can do that with. So it really doesn't matter what your age bracket is. You can create a really powerful machine and create that efficiency that's going to give you better opportunities with those dollars.
That makes complete sense to me, Nate. And I actually completely agree. George, did you have something to add?
Yeah, for sure. So I think all four of those aspects are incredibly powerful, each on its own. But when you put them all together, often one of the things that I've heard over the years is it's not always the seen, but also the unseen. So what does control do for you? What does certainty do for you? What does flexibility? What is liquidity? What do those attributes, those characteristics do for you on top of what you're trying to accomplish? So most people are fixated on rates, right? Rates. Nelson always said it's not about the rate. It's about the volume, and it's about what we do with those dollars and how we put them to work in multiple ways at the same time. So we can accomplish multiple things. That's the Swiss Army knife aspect of it. We can do multiple things at the same time with our dollars. And we always have options. We always have flexibility. And with ownership, because we are owners of the policy and potentially owners of the company, when it's mutually owned, we are shareholders of the company. We have control. We are on the other side of the coin where we're the owners, we're the bankers. We have that control and flexibility. So it's not always what we see, but also the unseen, which can be very, very powerful.
George, that reminds me of something that Ryan Griggs said recently. Banks, they make loans and they take payments. Insurance companies make loans and they take payments. You can either be the consumer in that process or you can be the owner in that process.
That's super, super powerful, Nate. Does anyone else on the panel have anything to add on the note of my question relating to the efficiency, depending on your stage of life, or anything else relating to the four main pillars that Nate outlines in his video before we move on to our next question?
I think what I would sort of add is that efficiency is your friend, and time is your friend. And so you either have a lot of time or you have a lot of capacity. And for particularly our younger listeners, you have time, and time passes. Just ask some of us old guys, time passes pretty quick. And efficiency actually maximizes the opportunity, the potential of your wealth. And so most of us just haven't taken the time to sit down and really calculate and understand and pay attention to what happens with time. But efficiency, once we capitalize, efficiency really, really starts to profoundly affect our wealth building.
And Wayne, one thing that I just thought about is as we become more efficient, that also raises the level of certainty that we can expect in our strategies.
It definitely does. And so thank you guys all for adding all those insights there. And with that, I'd love to talk about the concept of the family bank and what that really means. For some of the people in the audience, they may not be as familiar with the concept of a family bank and how to maximize the financial benefits of a family bank. So, Nate, if you want to kick it off, that'd be great.
Yeah, I love talking about this because I think about it like a family tree. So for me, as an example, I've got 4 kids. If we fast forward 10 years down the road, I'll probably have 8 people, so to speak, underneath me. between my kids and their spouses, maybe even some grandkids along the way. Who knows? So if you got me and my wife at the top, and then you got 8 people underneath us without any sort of system in place, all the payments and interest are going to be going out the door to Chase, Wells Fargo, Capital One, Bank of America, you name it. But if we have a system in place, if we created this family banking system, that means all the payments are not only going to stay in the family, but they're going to continue to cycle through the family. And so as loans are issued out to kids and grandkids, those repayments of those loans are sent back to mom and dad. And that really creates a really beautiful environment, because now you've got passive income going back to mom and dad. The kids are no longer subject to a bank's terms. So they've created some freedom and some flexibility in their life. They are funding their life, and they're simultaneously fueling their inheritance, because eventually it's all going to trickle back down to the kids. And I think it's a beautiful concept. And when done properly, it can empower a lot of generations to come. But we got to make sure that the education follows with it.
I think that's extremely powerful, Nate. And the multi-generational aspect is incredibly powerful. And I wouldn't use the word trickle down. I would say snowball. So as we pass our wealth from generation to generation, it grows like a snowball going down a great big hill. Just gets bigger and bigger and bigger and more powerful. And we have to start somewhere, right? We can't go back in time. We can only go forward. So we have to start somewhere. And when we start as parents and grandparents, we are setting our children and our grandchildren and our future generations up for success. And the educational aspect is crucial. Right. So I know a lot of people have heard, the stories around the Rockefellers and the Vanderbilts. So the Rockefellers did it right. They used insurance, they used trusts, and they had a family system that works very well. The Vanderbilts did not, and there's not a millionaire left in the family. So you have to have a plan. You have to implement that plan, and the generational wealth transfer is incredible. Not to mention that life insurance is 100% tax-free. So this is what the wealthy do. This is how they transfer their wealth to the next generation in a tax-free environment. Extremely powerful.
If I could jump in, so here we're sort of stressing the family element of it in terms, that phrase family bank, but the bank element. So to be clear, we always want to make sure these are life insurance products. It's not a bank account. You got to make sure you're clear with people. But the reason Nelson Nash said becoming your own banker, and is that what he wanted to get across was he's not telling you to invest in life insurance, right? So even though earlier, even in this very spaces discussion, we had talked about the different attributes, and and I was even saying how look at different asset classes, and I think Liz made a similar point. But to avoid confusion, the way I know Nelson thought about it, and he's certainly, the people that followed his lead endorsed this approach. It's not that he's saying, hey, you got your gold, you got your real estate, and why don't you get some life insurance too and get this whole life product. It was more the headquarters that everything else went through here. It wasn't an investment. So it was like where you parked your money, like keeping your powder dry. And then, if you wanted to go invest in some land, then, you had access to do it. So that's where this terminology of like a banking system comes into play, just to make sure for people who are newcomers to this, that you're getting that critical element, that's why Nelson used that analogy or that metaphor, is because it's like you got money coming and going, and this is like the headquarters of it. This is where your control center. So it's not that you're investing in whole life insurance. This is the platform or the vehicle through which you manage the things you might want to invest in, for example.
Bob, I kind of think of it like the heart of your financial plan. And you think about the job of the heart in our bodies, it's so blood flows through. And so blood flows in, and then it gets pumped out. And so we flow money into our whole life insurance, and then potentially we can send it back out into our life, either for financing expenses or for investments, other investments we want to be a part of or something like that. But when you really start to think through it from that perspective, the traditional retirement model, the accumulation model is very broken, I believe, because there's too many factors. In fact, I just posted a sort of a long tweet about this, about the broken accumulation model. So having the ability to take our monthly cash flow and potentially make it stronger, put some muscles behind it, is going to enable us to accomplish the things that we want to accomplish. And it's going to provide, it's going to give us opportunities. As Nelson said, and I've heard, other people say, opportunity will find capital. And so when I was talking earlier and I said, let's position ourselves so that we have access to capital, we don't even have to go chasing opportunities, because those opportunities will find us if we are positioned correctly, if we set ourselves up correctly.
It's interesting as we think about this concept of family. I've got two buddies that just passed away with cancer in the last couple of weeks, and all of a sudden, all of their wealth, all of their assets are now going to flow to their family. And I'm going, in one case, I'm thinking of a fair bit of wealth, 4 adult children, and they're now going to receive something without a plan. And we need systems. I mean, we're in the middle of the NHL playoffs right now, and every team has a system, and they execute that system. And really, whoever executes best is going to win. And so it's interesting to me that these families have been each doing their own thing, charting their own course, making their own choices, learning their own lessons, some good, some bad. And all of a sudden, dad's gone, and the assets now have to flow down to the kids. And I'm going, now what? It's a scramble. It's like herding cats. What would happen if we were laser focused right from the time we were young? We were thinking as a family. We were educating as a family. We were working the system intentionally and systematically and with focus and laser-like certainty. And all of a sudden, now this has happened. It's already been planned for. We were aware of it, and we're now going to maximize our family opportunities and flow that down to our future generations. And so it's just so interesting to me when you watch it happen in real time and go, this could have been so much better. This could have been so much more efficient. There could have been so much more wealth had we actually paid attention and taken time to understand the flow of money and how capital actually works.
And I think, unfortunately, the talking heads out there have done a lot of people a disservice in fully understanding whole life insurance and what the message we're trying to get across. And either that's by intentional agenda or just ignorance, either way. But the argument when we're talking about whole life insurance, the counter argument is, oh, you could just go invest in all these other things and buy term, all this other stuff. But what they're trying to compare it to cannot accurately really tell the story, because what they're attempting to do is compare whole life insurance to all the other investments out there, all the other assets out there, or whatever. And as we're talking about, whole life insurance is not an investment. This is a savings vehicle. It's a life insurance policy, just plain and simple, but it can act as a savings vehicle. It can act as a banking tool. And it can really empower, as we said, those dollars to be able to send them out into other places of our life and maintain the control of that capital and maintain the opportunity cost, the ability to receive that opportunity cost back into our lives.
Thanks, guys. That was incredible. And I know I just learned a ton there. And so with that, I really would like to nail down a little bit on the real world applications of having a family bank. For example, Wayne, if you don't mind me sharing, I know you have your Phoenix Fund, which I love. It's a great application. We've talked a lot about investing and about as a wealth transfer tool, but what are some of the other innovative real life applications you guys are implementing your guys selves with infinite banking, or have seen your guys' clients implement? And maybe to kick us off, Wayne, you could give us a little context on the Phoenix Fund.
Yeah, so anytime you can identify a consistent, regular expenditure, if you can allocate or isolate the capital that it's going to take for that to happen, you don't have to actually leak capital. You can allocate a certain amount of dollars to an isolated opportunity, and then you just cash flow on that. So about 15 years ago, we started going to Phoenix in the winter, and it cost us some money to do that. And so we immediately went to work at isolating the cost of that annual trip. We put it into a properly structured policy. And each year when we go to Phoenix, we enjoy ourselves. We come home, we find out what it costs us to go. We pull money out of our structure. We pay that bill, and we begin to replenish it for next year. And so now we've got 15 years of uninterrupted compounding on our capital. We've got 15 years of memories and stories and enjoyment in Phoenix. And we've got a growing tool that continues to finance all kinds of other opportunities, including our Phoenix trip. And so I just built the Phoenix Fund as a way to show clients this is one application that it can work for, but any regular, consistent expenditure, if you can get capital set aside for it and then just cash flow against it, you win. Your capital compounds, it grows, it multiplies all the time while you're enjoying the benefit or the opportunity that you set out to achieve, and grows your wealth. And now we can help our children with some of those same opportunities. And so it's just a really efficient, effective, and fun way to actually manage capital.
I completely agree, Wayne. And I just think it's such a great example of some of the advantages of leveraging a whole life insurance policy. It really, like, for example, a lot of people, when they'd go to take that trip right now, would expense a lot of things on a credit card. And that just doesn't make sense when you have the cash flow. And so I'd love to start talking a little more about the advantages of leveraging whole life insurance specifically, and kind of what the process actually looks like to take out a loan against your policy. How does that happen? Who do you go to? Are the rates competitive? Nate, if you want to kick us off with a little bit about, or a little bit of a breakdown of the process of borrowing against your policy, that'd be great.
Perfect. Yeah, I'll use an example that I use often whenever I'm coaching others and helping them kind of wrap their mind around how policy loans work. And y'all correct me if I say anything that's incorrect, but imagine, just for simple numbers, let's say you had $10,000 that you wanted to borrow against your policy. So you built up your account values, and you decided to take a $10,000 policy loan. So when you request that policy loan from the life insurance company, there is a prepaid set interest that is paid on the loan up front. So what it is, like if it was 5%, as an example, if the loan rate was 5%, that amount is subtracted out up front. So if I requested a $10,000 policy loan, then they would hold back $500, and they're going to send me $9,500. Now, for the next 12 months, my total cost of capital is at $500. So I have full flexibility for the next 12 months as far as how I might want to put that to work or something like that, how I might want to repay it. So if I pay the policy loan off in 6 months, the insurance company is actually going to credit half of that interest back to me, because you only pay interest on the outstanding amount that you have at the time. But the beauty of that is, if $500 is my only cost of capital, what can I do with $9,500 now to offset? What kind of value can I create with $9,500 to potentially close the gap on the cost of capital? Now, that's just how the loans work on taking policy loans from the insurance company. What you also have to factor in is there is uninterrupted growth on your principal cash value, whatever that is at the time. So that in and of itself is closing the gap on the cost of capital. There's cost of capital in everything that we do. But if we can figure out how to close the gap on that cost of capital, then our money that we're borrowing becomes very, very cheap compared to what the world has access to.
I would. Can you okay now? You got.
It's still pretty hard, George.
Okay. Go ahead, Bob.
Okay, yeah, sure. I'll just jump in. So it's I would just add with to what Nate said there, that just to make sure, again, I know we have a mixture of like old pros and newcomers to this. The the reason people talk about the uninterrupted growth and so forth, what's happening under the hood, just to make sure everyone gets this basic point who's tuning in, is the life insurance company is lending you the money with your policy, or some might say the cash surrender value of your policy, serving as the collateral. So you're not taking money, quote, out of your policy. So that's, if it's growing, doing its thing, it's going to keep doing that. There's some complications that we don't need to get into right now about the difference of the way the dividends are credited, that, there could be some nuance, but the basic story of what I'm saying is certainly correct no matter what kind of company you have. And in principle, and I saw a critic one time try to denigrate this whole process. So this guy thought this was all smoke and mirrors, and he said, all that's going on is you build up an asset and then you borrow against it. He said, it's the same thing like if you had a house and you had equity in the house and you went to a bank and borrowed against the equity in your house. It's the same thing. You don't need to do this. And so I think that's a good thing just to explain briefly, because he's right in terms of like the economic essence of what's going on. There is a superficial similarity, but he's wrong in thinking, so there's no advantage to doing it with the whole life policy versus some other asset like a real estate. And the difference is, if just very quickly here, is when you apply for a policy loan, going back to what Jackson was saying, like what's the process? Like depending on what company you use, you can go online someplace like my policy. I just go online and I type in the policy loan, and it, I have to verify, I think like the last 4 digits of my bank account or something, just so they know it's me. And then, that thing will hit my account within 48 hours typically, if it's not, going over a weekend. Whereas if you went to a bank and said, yeah, here, I have equity in my house, I'd like to borrow $10,000 against that, they're going to check your credit. They're going to see what your income is. They're going to have a defined payback schedule. They're going to do a lot of stuff. And the reason for that difference, whereas with the life insurance company, they don't check your credit. They don't do any of that stuff. They don't care even if you never pay it back. It just rolls over at the interest rate that, is on the policy loan. So why is there this chasm in the treatment between how these loans work? It's because of the nature of the collateral. So to the life insurance company, the fact that they themselves are guaranteeing the collateral because they're lending to you against this thing where you can surrender the policy and they owe you a bunch of money, or if the insured dies, they owe the beneficiaries a bunch of money. They know they're getting paid back. They just do a subtraction problem and then, send the net difference out the door, depending on whether you surrendered or there was a death. Whereas with like the real estate, home equity loan, if you fall behind on your payments, ultimately the bank is going to have to kick you out of your house, foreclose, sell the house, and pay themselves back that way. That's a huge process, a real pain. They have to get the police involved. And the real estate market could crash in the meantime. So even if it's a well-collateralized loan when the loan originally happens, the market could go down. And maybe you're underwater. Whereas, again, the life insurance company is the one guaranteeing the cash value in your whole life policy isn't going to drop 30% because the market tanked. That can't happen. So, again, just some of the differences that, for me as an economist coming in to understand, like, why did Nelson Nash pick this as the asset to build this whole system around? And these are some of the reasons why, in case you're wondering, like, what the heck does whole life insurance have to do with managing a family bank? Well, this is why. It's because of the convenience and accessibility of this loan process that just makes it so wonderful for this particular application.
I completely agree. And I think that was some really important context there, Dr. Murphy. Thank you for adding that. I don't know if anyone on the panel has any thoughts about what Dr. Murphy said about kind of the ease of taking out loans with whole life insurance and the difference in terms of taking out loans against potentially other sorts of collateral you may have. Yeah, Wayne.
Yeah, so this week I had a client phone me while they were traveling to some other appointments and said, "Hey, we have an opportunity. We're going to borrow some capital to seize that opportunity. Can you look after that?" And I said yes, and I was on a Zoom call, so he hung up. That was the amount of time it took him to access capital. That money will have arrived in his account either today or Friday or Monday, and he will go ahead and pursue the opportunity. But before he hung up the phone, he said, "Once this is all ready for market, I'm going to go to the bank and ask them whether they'd like to be a partner with me, and whether they choose to or not choose to. They can do all their paperwork and fiddle work, but I've already got the asset. It's already at work, and I can do that with or without their help. But if they're so inclined to participate, they just freed up some more capital so I can seize a new opportunity." And so I just love the simplicity and the ability to turn capital over profitably and be in control, which is really the 4 points, control, certainty, efficiency, and liquidity. All of those things came into play in that situation, and it was a 4-minute telephone call.
I think that's a really important point, Wayne, and something that certainly business owners that I work with really appreciate is this speed to access the liquidity. So generally in business and with opportunities, the pace at which you can access that liquidity does make a difference to you being able to participate in that opportunity. So not having to go through an extensive process of justification, as Bob mentioned, Dr. Murphy spoke to about, having to have the different criteria met to be able to access, money from a loan with the bank. Just having that ability to seize the opportunity, and then after the fact you can go and work out whatever arrangement you want or continue on with the policy loan. And just having that level of flexibility is something that people almost find hard to believe even the first time it happens to them. They're like, what? It's really this easy? So it's fun to see that reaction with people as they start to use and understand the power of having that control. Sort of back to the beginning of the call, that control and the liquidity makes a huge difference in how you can operate and manage your business.
100%. And there was one benefit that we started to talk about a little bit earlier that I don't know if we fully explained yet or necessarily dove into, but there is a tax advantage in utilizing infinite banking for cash management. And so I'd love to talk a little bit more about what the tax advantages are of utilizing a whole life insurance policy, and how it compares to other financial instruments that may have other sort of tax advantages. Nate, if you'd like to kick us off, you can, or if anyone else has anything.
Sure. So from the perspective of treating your policy, your behavior, if you treat your policy the right way, and you follow the IRS rules, because there are IRS rules that are in place, and if we stay within those boundaries, then this is a tax-free strategy, as long as you're treating your policy the right way. So if you draw anything out of your policy that exceeds the cost basis, then you would be subject to taxation as far as that goes. But if you are treating your strategy the right way, and you're staying within those boundaries of the modified endowment contract, then you'll just get to experience the pure growth of your system going forward.
And that compares with people that say, buy term invest the difference, and they don't necessarily account for capital gains tax if they're investing in index funds per se. And that definitely hurts.
Well, and here's the problem with buy term invest the difference. What's the difference? Because this is where people screw up in following that model. Well, in one case. So the difference, that word difference, is supposed to be the difference between term insurance and whole life insurance. So what you are supposed to do is you're supposed to go investigate both. And the difference between the two, you're supposed to be investing in the market. But what most people do is they buy as much death benefit as they can get with they get the biggest death benefit they can get for the smallest premium, essentially. They kind of shop it around. They're like, let me see what I can get. And they get what they think they need. And here's the problem with that. Let's use house insurance as an example. So let's say your home burns down and you don't have any insurance. And an insurance agent shows up and says, hey, I have this homeowner's policy that I can sell you right now. It'll be retroactive for the accident that just occurred. How much insurance do you want? You're going to want as much as it takes to cover that. But see, we go through this, the traditional thought process is we go off of what we think we need. And the reality is we don't know what we need. So why don't we just go for it all? Why don't we understand that we can actually move into a place of maximum protection and give us a lot more opportunities to be able to move freely in our financial life?
Nate, that elegantly, brought us to our next point, which was going to be the protection elements in whole life insurance. And you definitely are protected, and you also have the flexibility and the control that we hit on. But if you could potentially touch on, people may be listening to this and may be worried, if I start one of these policies and something happens to me, what is going to happen if I'm on the hook for these premiums? Could you potentially discuss the multiple layers of protection offered in whole life insurance? We just discussed by death benefits, but by different riders and waivers of premium potentially that exist for different situations.
Absolutely. So, the layers of protection, one, you've got like a chronic illness rider. So that if something happened where you were chronic or terminal, something like that, and you needed access to a portion of your death benefit up front to cover medical costs or something like that, then that is available to you. You also have a lot of companies offer, or some companies offer, the disability waiver premium option, which I think is really cool, because if you became disabled and you could not go to work, in a normal setting, even if you have disability insurance, you're in survival mode at that point, which means you're not thinking about how am I going to invest in my future or anything like that. You're thinking, how am I going to pay my bills? If you're reduced to 60 to 70% of the income that you were once accustomed to. But if you have a disability waiver premium on your policy and you also have disability insurance, now you have a self-completing strategy, which means even if you became disabled, the insurance company is going to step in and pay your premiums, which is really powerful. Now your probability of failure is reduced substantially when it comes to what you're wanting to accomplish in your financial life. So, and then whole life insurance in most states is also creditor protected, which against lawsuits and stuff like that, which means somebody can't actually access the money that you've put in your policy, which is really cool. So there's a lot of different layers of protection that make this really powerful. And obviously the most important, the most obvious is the death benefit. So imagine, I had this epiphany when I was playing with my kids on the beach one day, that all the money that's flowing through my life today, not a portion of it, but because of the way I'm positioned now, all of the money that's flowing through my life today is going to eventually pass on to my kids. And life insurance is just a perpetuation of your income onto the next generation. And I actually heard that recently, and I never heard it that way before, but it's really powerful because that means that when I jump off this earth one day, when I graduate, as Nelson used to say, my income that I was making in my working years will perpetuate on to my kids. So now my income gets to stack on top of their income. And like we were talking about earlier, if we do a really great job of education and making sure future generations understand this, then we can create a fundamental shift in our economy.
I completely agree there, Nate. Does anyone have anything to add?
Let me just chime in real fast, more circling back to an earlier question about the tax treatment. And this is just a point that I emphasize a lot, that it's not that, I mean, obviously when politics get involved, you know, every industry has its lobbyists and so forth, but especially like the advantageous tax treatment, at least if you handle the policies properly and don't what's called MEC it turn into a modified endowment contract. In most cases, like the advantageous tax treatment is not some quirky thing that, you know, is a weird loophole. Like just to give some examples. So, you know, typically the death benefit's going to pass income tax free to the beneficiaries. That's not weird. Just like if you got in a car crash and the auto insurance company sent you a check to fix your car, that's not treated as taxable income. That's not as if like your boss gave you a bonus at work. You know, I mean, it's replenishing you. It's making you whole from the loss. So the same thing with life insurance, that, you know, you have ostensibly an insurable interest in, you know, the people that are getting the beneficiary check. So there's that element involved. And then also to be able, you know, these policy loans that we've been talking about for a lot of this call, again, as long as you conduct your policy correctly, it stays classified not as what's called a modified endowment contract. The policy loans are not taxable income. But again, that's not some weird loophole. That makes total sense because it's a loan, right? There's a lien against your policy. And so if you surrender it or the insured died, that policy loan gets subtracted from, you know, the balance gets subtracted from the money that's otherwise owed to somebody by the insurance company. So the money coming in the door, you know, like Wayne's clients, when they saw that opportunity and they're going to get the policy loan to go take advantage of it, that's not net income to them. And so it shouldn't be taxed as such, and it's not. So I just want to clarify that, yes, if you do things properly, it makes a lot of sense, especially when you take into account tax considerations. But it's not that rests on some edifice of like crazy loopholes that lobbyists have gotten on behalf of life insurance companies. It makes economic sense, the tax treatment of this stuff.
Thank you for adding that, Dr. Murphy. I think that was super helpful for me and for our listeners here. As we move into our last 10 minutes of the space here, we have a couple of topics left that I'd love to hit on. And so next, I'd love to kind of compare and contrast here. A lot of people like to look at real estate as the end-all be-all. You can invest in it. It's more likely than not going to appreciate. You can get your capital out when you need it through HELOCs. But there are a bunch of differences between the control and the certainty. And I'd even argue the efficiency as well as the liquidity aspects, that they're really just not the same. I mean, at least with real estate investments, they tend to be more variable. And so I'd love if we could kind of compare and contrast utilizing real estate, as a lot of people tend to do, versus whole life insurance.
I just tell people they should do both. And yeah, the way we think through this is like, if I've got equity, so whole life insurance is an asset. It's a forgotten asset class, and most people don't think of it as an asset, but it is an asset. And so as we're building cash value, or what some would consider equity when we're talking about real estate, so we're building up that equity or cash value inside that policy, and we can simultaneously put it to work into another asset, potentially real estate. Now we've got equity in two different assets with the same dollar, which is really crazy. And like most people don't operate at that level. And so when you think through it in those terms, it can be really powerful, because the whole life insurance environment you control. you don't control the real estate environment. So once it goes outside of the policy, that's where uncertainty comes in. But the level of risk that you take with investments is really dependent on your level of understanding and education in that investment. So if you're putting your money into something that you don't understand, that's on you. Put your money into things that you understand. And then that will reduce your level of risk. Because I'm friends with a guy who invests in restaurants, and he is doing extremely well in restaurants. You know what I would do in restaurants? Not very much, because I don't know anything about restaurants. So my money is risky in restaurants. His money is safe in restaurants because he understands that. So we don't have to understand a whole lot about whole life insurance because we control the environment. And then we can simultaneously put that responsibility on ourselves to become educated in things that we're putting our money into. That's one of the frustrating things for me with 401ks, as an example, is most people who have a 401k can't explain it and don't understand it. They just think that's what they're supposed to do. And I'm not against people putting money in the market. I'm against people putting money into things that they don't understand.
That's super powerful, Nate. Our other panelists, do you guys have anything to add to Nate's comments there?
Sure, I can jump in. So again, I don't need to go recapitulate the whole thing, but that point I made earlier, again, showing the difference between real estate and whole life insurance as a method, like an asset that builds up. So I know, Nate, the video that we have pinned on this to point people to, that you did use real estate as an analogy that people get how, yeah, you can build equity and you're flipping homes and stuff. And then also it's good because the value of your properties is going up whether or not you borrow against it, right? So people get the idea that, oh yeah, if it's a rising property, asset, that I still get those gains, even though I can also get some liquidity by borrowing against it with other people's money, kind of deal. But again, so that analogy holds up with life insurance. That is in essence what you're doing. But again, a pretty crucial difference, and the reason people like Nelson thought, no, the asset you want to use for, quote, infinite banking is a dividend-paying whole life policy, is that with the real estate market, yeah, typically the value goes up. There could be a real estate crash. That certainly happens every once in a while, where you can't have a crash in your whole life policy. And so that's in terms of just having something you can, quote, bank on, no pun intended. That's why Nelson thought this is a much better asset for that purpose, even though to someone who's like a real estate investor who doesn't know how life insurance works, you can use that to start the conversation. But there are reasons once they see the analogy to say, you should start doing it with this thing.
Thank you for that, Dr. Murphy. And I know that we're getting really close on time here. For those of you that may have joined a little later, I've moved that video that has guided our conversation that Nate has recently produced to the front here. It's the first pinned tweet now, or the most recent pinned tweet now. If you want to go ahead and bookmark that and watch that after the space, that'd be great. And then there are a couple other resources here that we've put up during the conversation that you may want to check out. And guys, if we have time for one more question, Dr. Murphy, I think you just brought up an aspect of it, or of infinite banking that we hadn't talked about that would be really helpful to explain before wrapping things up here. You mentioned a dividend-paying whole life insurance policy. And so we've talked a lot about the cash value growth and what that means. But Nate, if you could potentially explain for our listeners what the dividends actually are. I know you did a little bit earlier, but where the dividends come from, and then if anyone else wants to add a little bit on the dividend aspects of whole life insurance policies, that'd be great.
Well, very simply, dividends, just like with stock companies that are out there, they pay dividends based off of profitability. They look at how profitable they were, and they pay out a portion of the profits to their stockholders or shareholders. Well, with a mutual life insurance company, as a policy owner, we get to participate in the profitability of the company through dividends, and the long-term growth of that company. And so That's simply what's happening here is the insurance company projects how much money it's going to take to run their operations. And then when there's a surplus, they return a portion of that surplus back to the policy owners.
And that's in addition to the cash value growth, right? I just think that that's a clear distinction to make.
That is correct. And in a lot of cases, dividends are not guaranteed, but we work with companies that have a 100-year plus track record of paying dividends. So there is a high probability of dividends getting paid out, but we always like to make sure people understand dividends are not guaranteed. But in a lot of cases, the dividends will exceed the contractual rate of growth whenever you're looking at those illustrations and things like that.
Great. Thank you for adding clarity there, Nate. Dr. Murphy, did you have something to add?
Yeah, just real quick. Just to be clear to people again. So yes, you could have a basic policy. If you just look at the guaranteed side, the cash value marches up and it's going to eventually equal the death benefit at age 100 or age 121 when the thing matures. But if you elect to receive, if you roll the dividends back into the policy to do what's called paid up additions, then that boosts the cash value also. So it's like it boosts the cash value to a new plateau from which it can't go down. So right, the dividends are not guaranteed, but if you do, once you do get a dividend declared, and if you choose to roll it back into your policy, now your guaranteed floor is at a new higher plateau, just to be clear.
Thank you for adding that, Dr. Murphy. And with that, guys, this has been such an incredible conversation. I know I've learned so much, and I can probably speak for our listeners and say they have as well. This has been a really stacked panel, and I think I can say my favorite infinite banking panel we've had to date. We still had a couple topics to get through, but we're up on time. And so hopefully, Nate, we'll be able to have you back on in the future. This has been a lot of fun. Before we sign off here, I'd love to give you, Nate, a chance to tell the audience where they can find you. I know you have a newsletter. If they want to stay in contact, if they want to learn more, how should they get in contact?
Well, yeah, so the easiest place to reach me, obviously, is right here on Twitter. I do have a newsletter, and our website is bethebank.me if you want to go check out our website. And then we also launched our podcast back in October, which is Cashflow Legends. Legends is spelled with a Z. You can find us on all platforms, including YouTube.
Perfect. I just pinned your tweet with your newsletter. So if anyone wants to keep up with Nate here and everything going on in the infinite banking world, I highly suggest that you subscribe to that newsletter. And on the Infineo side, you tuned into our infinite banking space. We host these every Tuesday at 12 p.m. Eastern. And we try to really shed light on what infinite banking is, how to manage your cash with whole life insurance, and what that really means. We do that with our team of experts here at Infineo, and we were really, really honored to have Nate Gein, the number one voice on X in infinite banking, here on our space today. And so once again, thank you so much, Nate. Thank you to our panelists for being here, and thank you to the audience for listening. If you guys have any questions or want to stay in contact with us, we also have our newsletter. If you want to subscribe to that, go to infineo.ai/#newsletter. Again, infineo.ai/#newsletter. Or you can just follow us on Twitter here. We're having weekly Twitter spaces, alternating topics between whole life insurance and real world asset tokenization. We hope to see you on our next ones. Thank you, everyone, for listening in today.